All right, so the House of Representatives passed their budget resolution a few weeks ago, and in that resolution, it calls for some massive spending cuts over the next 10-year period, and they're also projecting some significant decreases in the amount of federal tax revenue that's going to be collected. So now the big question is, what are they going to be doing as far as tax reform to be able to meet these projections as far as what they want to collect in tax dollars each year? Now, it's very likely that a lot of these provisions in the Tax Cuts and Jobs Act will be extended. So the TCJA, or Tax Cuts and Jobs Act, was passed in 2017. It went into effect for the 2018 tax year. And all of those provisions are set to expire at the end of 2025. So starting Jan 1, 2026, the tax code basically reverts back to what it was in 2017 and prior years. Now, some of these items that are likely going to be extended are certainly the increased child tax credit, the increase on the phase out. So remember, the child tax credit increased under the TCJA, and they bumped up the ranges as far as what kind of income you would have to fall with under in order to get it. In other words, the TCJA allowed many, many more taxpayers with children to be able to claim the credit without them phasing out. So that was a big win for American families that have one or more qualifying children. The other items that are certainly going to stay in place are things like the qualified business income deduction. So that QBI deduction under Section 199 Cap A basically provides a 20% deduction on pass-through income from partnerships, S-corps, sole proprietorship businesses, and things like that. So likely that'll stay in place. And then also the corporate tax rate as well. So that was 35%. That was dropped to 21%. The Trump administration has even floated maybe making that rate even lower to try to be more competitive with other countries that have much lower corporate tax rates. So the one big sticking point, however, is the state and local tax deduction, or SALT for short. So the SALT cap went into place under the TCJA, and it limited the amount of state and local taxes that you could deduct as an itemized deduction. So if we look at just a very simple example here, so this is a Schedule A for itemized deductions. Let's say we have a taxpayer here, Amy, who lives and works in California. And so on her Schedule A for 2024, she's reporting that she paid $17,500 in California state income taxes. She had some property taxes because she's a homeowner. And so let's say that the total taxes, state and local taxes she had for the year were a little over $20,000. Well, because of this SALT cap in place, she can't deduct anything more than $10,000. Now, pre the TCJA, all of this was deductible. And so what it did was certainly shift a lot of the tax dollars that would go to the federal government back to the states, because your federal taxable income is going to be lower than what you pay at the state level. So you can imagine there's a lot of taxpayers, certainly the one percenters, that are paying some exorbitant state income taxes. Maybe they have a big house and their property taxes are 80, 90 grand a year. No matter what that amount totals to, the maximum amount they'd be able to deduct is $10,000. So this is the one piece, and even President Trump himself has said during his campaign that he would relook at this and try to change that treatment. So if we have a look at some more of the details here, so the lawmakers are debating President Trump's tax cuts, and then as noted here in the article, a key deduction would be the SALT deduction is going to be a sticking point. So obviously representatives in high tax states like California, New York, they have a real problem with this SALT cap, regardless of what your party affiliation is. Because if you're paying, whether you're a Republican or a Democrat living in these states, this provision applies to you. And what they're seeing is they're paying a lot more federal income taxes than they did previously, and certainly otherwise would want to be able to do. So the SALT provision is going to expire after 2025 without any action from Congress. So if they do nothing, it will expire. It'll go back to being just an unlimited deduction for state and local income taxes. But the likelihood of it completely expiring, I don't think is very probable. What likely is going to happen is they're just going to increase this amount, right? So instead of making it $10,000, which is quite low, they might bump that up to, let's say, 50,000. So if you are living in a state that has state income taxes, you have property taxes because you're a homeowner, you'll get a little bit more breathing room if they increase that to, again, let's say 40 or 50 grand. And so that'll help out a lot of taxpayers that live in those high tax states. Now, the Tax Foundation, this is a nonprofit organization, a think tank, if you will, over in the U.S. And so they do these analyses on the tax proposals. Now, because there's no bill that's been admitted to Congress yet for consideration, their analysis done back in October was simply based on what President Trump said when he was giving speeches or during his campaign trail, and what would be the likely impact if some of these things went through. So the president has floated a number of tax policy ideas, including extending the TCJA changes. So again, I think that the vast majority of the provisions in the TCJA President Trump still likes. And so he will extend most of those, or he'll push Congress to want to extend most of those. But one of the things is maybe going to change is bringing back the deduction for state and local taxes without that cap. Or again, like I said earlier, maybe keeping the cap in place, but just increasing it to a much higher threshold. So they've done their analyses and projections here. If we look at some of the impact on these proposals. So they've got, so they've got some data down here, right? So if they make permanent the individual estate and business provisions, it's going to increase, according to their projections, long run economic output by 1.1% when modeled with a cap on the SALT deductions of $10,000. However, if the proposal to get SALT back means getting rid of the $10,000 cap, it would boost GDP by an additional 0.7%, as SALT cap creates a burden on labor income as well as housing investment. All right. Let's see, some other key provisions in here. Yeah, so here's what the revenue impact is on some of these. So the proposed tax changes would reduce federal tax revenue by $3 trillion over the next 10-year period. The permanence of the individual provisions would reduce revenue by $3.4 trillion if the SALT cap is made permanent. So if they keep that SALT cap in there of $10,000, they still project that total revenue over the 10-year period would drop by $3.4 trillion. Now, if they extend the individual provisions and do not have a cap on SALT, so if they go back to 2017 and prior years where there was no cap on the itemized deduction, it would add an additional $1 trillion. So there would be up to $4.4 trillion reduction in revenue over that 10-year period. So that just shows you how much that SALT cap really impacted federal revenue collections. By having that thing in place, they're estimating that about adds $1 trillion in collected revenue over a 10-year period. So a big change, right? I mean, I think, again, from what President Trump has said, just to recap here, he certainly likes a lot of the provisions that are in the TCJA, but that SALT cap, he's getting a lot of pushback from both Republicans and Democrats alike. So will he change that? My guess is yes. Will it be totally done away with? I don't think so. I think they'll keep that in there. They'll just increase that substantially, maybe. It could be 50 grand, 100 grand, who knows? But I think they'll keep it in place. They'll just increase it from $10,000 because what they've seen is that $10,000 is really, really low because it includes not just those state income taxes, but also property taxes. A lot of taxpayers pay 7, 8, 10 grand a year in just property tax alone before they even get to consider their state and local income taxes that might apply. So that covers it for this update. Hope that was helpful. Again, we'll keep monitoring this. As soon as either the House or the Senate gets a proposed bill in place and admitted to Congress, we'll get a better look at the actual details. I imagine they're working on that right now to try to figure it out. So still left to be seen. But again, a lot of these changes have to be made before the end of the year. Otherwise, the TCJA provisions expire. And so even though the expiration would mean that SALT cap goes away, all those other added benefits that were in the TCJA will disappear as well. So the QBI deduction, the reduced corporate rate, the increased child tax credit. So these are all things that a lot of individuals and businesses certainly like, as far as reducing their overall tax burden. All right, so that covers it. Thanks for watching, and as always, I appreciate you watching, and I look forward to seeing you on the next update. Thank you.